Are you wondering where mortgage rates and the real estate market are headed in 2026? Whether you're planning to buy, sell, refinance, or just understand the trends, this video will walk through what to expect. Let's dive in. For 2025, I predicted average mortgage rates would trend lower, but more later in the year, and not drop below 6% before 2026. That's exactly what happened. I said the Fed would cut short-term rates, but less than in 2024, and we saw the Fed cut 0.75% in 2025 versus 1% in 2024. I said inflation would continue to decline, and we saw core CPI drop from 3.2% to 2.7%, despite tariffs boosting goods prices. I predicted that the spread between the 10-year Treasury yield and 30-year mortgage rates would decline toward the pre-pandemic norm of 1.5 to 1.75%, and we've seen it now drop below 2%. For real estate, I predicted home prices would remain strong, especially in Hawaii. The Oahu median single-family home price rose 3.5% in 2025. For 2026, I expect mortgage rates to continue trending lower, though not in a straight line. The administration wants mortgage rates to move lower and will find methods such as Fannie Mae and Freddie Mac buying mortgage-backed securities and nominating a Fed chairman friendly to the rate markets to help that cause. I expect the Fed to continue cutting short-term rates, but no more than in 2025. They'll also switch from quantitative tightening the last couple of years to quantitative easing, helping to further reduce the spread between the 10-year Treasury yield and the 30-year mortgage rates. Longer term, the short-term Fed funds rate trends in the same direction as the 10-year Treasury yield and 30-year mortgage rates, and all three have been trending lower. I expect the effect of tariffs on goods prices to peak and then decline as year-over-year price comparisons drop from initial one-time price increases. Excluding the effects of tariffs, we'd already be at the Fed's 2% inflation target. Headline inflation should remain above the Fed's 2% target in 2026, but continue to stay close to there. I expect inflation to hit the Fed's 2% inflation target in 2027. With subdued inflation, consumer confidence at a 14-year low, and significantly slowed job growth, long-term rates should continue lower. As I've mentioned in the past, AI has kept productivity high, helping us avoid a recession thus far. But recession risks will increase with further weakening of the job market. There are still risks. The global holdings of U.S. bonds may be significantly reduced if some big bondholders like Japan and China decide to reduce their exposure. Global instability in areas like China, the Middle East, Russia, parts of Europe, and emerging markets could alter capital flows and U.S. Treasury yields. Despite ongoing predictions of a housing crash, the supply and demand situation is far worse today than it was in 2008. On the supply side, home building dropped dramatically after 2008, leaving the U.S. with a structural shortage of about 4 million homes. High land costs, labor shortages, and rising material prices mean builders won't build enough homes to fill the gap anytime soon, since they can't sell that many homes profitably if prices don't rise significantly more. The cost to build a home sets a floor under home prices, especially in supply-constrained markets. Transaction-wise, there are roughly 1 million homes listed for sale nationwide compared to 4 million listed in 2008. We won't see a housing crash without far more home inventory. On the demand side, the U.S. now has approximately 130 million households, up from about 117 million in 2008. There are far more first-time buyers entering the market than in prior cycles, driven by aging millennials for years to come. The administration is committed to coming up with ways to help buyers afford homes, suggesting a 50-year mortgage, using 401ks towards a down payment, and banning institutional investors. Even modest declines in mortgage rates can bring in a large number of buyers off the sidelines, increasing competition for limited inventory. We have far more households competing for far fewer homes, keeping home prices strong. Now, real estate is local. On Oahu, you can see from this chart that even the 2008 housing crash looks like just a pause in the long-term uptrend. A great opportunity for smart buyers to add more local real estate. Looking back, do you see any points where you would regret having bought a home you love and holding until now? Oahu single-family home inventory remains below 3 months, reflecting a strong market. In summary, I expect mortgage rates to continue trending lower in 2026, moving below the key 6% level. The spread between mortgage rates and the 10-year Treasury will continue to drop towards the 1.5 to 1.75% pre-pandemic norm. The Fed will continue to cut short-term rates, though not more than in 2025. Inflation will approach the Fed's 2% target after the impact of tariffs peaks. At the same time, home prices will remain strong, especially in markets with chronic supply shortages like Hawaii. The biggest risks remain policy-driven: tariffs, global bond market instability, and political pressure on monetary policy. But absent a major policy shock or a sharp increase in money supply growth, the overall trend points towards lower rates and resilient home values. A great environment for homeowners and home buyers. If you found this video helpful, please share it with anyone navigating the housing market. Please like and subscribe for a lot more useful information to come.